This is Al Brooks, and this is my price action trading course. The current module is about actual risk. Remember the trader's equation, and you only take a trade if the probability of success times the reward, your profit target, is greater than the probability of failure times your risk. And you want it to be substantially greater if you possibly can find a trade that would allow you to achieve that goal. If you know the probability and the risk, you can calculate the smallest target needed to have a positive trader's equation. In other words, to have a positive strategy, a successful strategy. You should always assume that the probability is between 40 and 60%. And to have a profitable strategy, when a trade looks good, you assume it's 60% likely of being successful. When that's the case, you need a reward at least as big as the risk to have a profitable strategy. Worst case is the probability is only 40%, and when that's the case, you need a reward at least twice as big as your risk. So if you look at a setup and you say, yeah, it's a setup, but I don't think it's going to work, then you need a reward twice as big as your risk at a minimum to have a positive trader's equation. You can make assumptions about probability. The setup is either clearly good, you look at it and you say, yeah, I think this is a good trade. When that's the case, assume you have a 60% chance of profit. If you look at it instead and say, yeah, I don't know, it might work, I think it's okay, but I'm not sure, then assume probability is 50%. If you look at it and you say, yeah, I don't know, I understand the logic behind the trade, but I think it's probably not all that good, then use 40% for the probability. The initial risk, you make assumptions about risk as well. The initial risk, most of the time, if you're buying, you'll place your protective stop below the signal bar, and that is your risk from one tick above the bar where you entered and one tick below the bar to where your protective stop is. If you're shorting, most of the time you'll use the high of the signal bar as your protective stop, and so your initial risk is 2 ticks greater than the height of the signal bar. Your stop is 1 tick above, you enter 1 tick below. Once the trade starts to go your way, you can adjust your stop and determine what your actual risk was. So after the trade starts to go your way, just count the number of ticks you would have needed for your stop to not have been stopped out. This is your actual risk. So if the market is, if you buy here and the market starts to go up, the lowest point the market went while you were in the trade plus 1 tick is your actual risk. And what's the smallest reward for a good trade? If you know the probability and the risk, you can calculate what that reward has to be. It's the smallest reward needed to have a positive trader's equation. You still have to go for a target that's at least as big as your new smaller risk, no matter how positive no matter how certain you are that the trade will work. You can take profits at your minimum target. When in doubt, you always take profits at 2 times actual risk, and this results in a positive equation. It is also therefore a reasonable minimum reward. So when you're not sure where to take profits, go for 2 times your actual risk. That's a reasonable minimum. You should always go for a target that is at least as big as the new smaller risk, your actual risk. And another rational minimum that you have to consider is maybe 1 point in the E-mini or 10 ticks in a stock. You don't want to go for targets less than that because commissions become a problem, slippage and execution issues become a problem. For example, let's say you went for a 2-tick scalp in the E-mini. If the commission is $5 for a round turn trade, then each winner is $25 minus the $5 commission, so you net $20. Each loser, you lose $25 plus you pay the $5 commission, so it costs you $30. And that's assuming you execute everything perfectly, don't make any mistakes in your decisions, in other words, taking bad trades, and you don't have any slippage. So if you take 10 trades and you win 60% of the time, You'll win $20 60% of the time and have $120 profit. You'll lose 4 trades times $30 and you'll lose $120. So after 10 trades, winning 60% of the time, you won't have any profit. And that's being 60% right. And therefore, if you're going for 2 ticks profit, you have to be right 80 to 90% of the time to make a living. And that's simply unrealistic. You need a positive trader's equation if you're going to make a living doing this. If you're taking a trade where the trader's equation is negative, you will lose money. And your target has to be big enough so that commissions are not too big compared to the profit. In general, you prefer to have commissions be maybe 5% of your profit. So if you're spending $5 round turn in the E-mini, you need to make maybe $100. You can make money on a 1-point profit target if the probability is high enough. Most traders should not be going for 1-point scalps in the E-mini. They should be going for 2-point scalps at a minimum. When 2 times the initial risk is too big, this is common in trading ranges. Then you have to reduce the target to 2 times the actual risk. So instead of using the initial risk, take a look at the actual risk and change your target. And if the probability is high enough, you can even exit at 1 times the actual risk. But for most traders, that I think is unrealistic. I think it's very difficult to make a living doing that unless you're an experienced trader. And even then, you have to make decisions very quickly. And you have to do it day in, day out, year after year. And I think that's beyond what most traders are willing to do. You can do it for short periods of time, but to try to do it for a career, I think it's too much. I think it's too much to expect most people to be willing to do that. Let's go through an example in the E-mini. Okay, at this point in the day, the market's been in a trading range. It tried to get above the high, turned down, went below the low, turned up, went above the high, turned down. It's now below the low and it's trying to turn up. And the move down had a bear bar, dojis, bear bar, bull bar, bear bar, bull bar. So trading range behavior. No series of bear bars. So the market probably will try to turn up here or soon. You see a very good looking bull reversal bar. 3 pushes down, 1, 2, 3, or you could argue it's a high 2. There's a high 1 triggering above this bar, or you could say this is a strong first leg down, and then we have another leg down. It doesn't matter if you call it a high 2, a high 3, it doesn't matter. What you see is a strong bull reversal bar, new low of the day on a trading range day. The decision is whether or not this bull bar is strong enough to reverse this bear breakout bar. You might decide to wait for a second signal, and in fact you would have gotten one here, but at this moment you would not know that. Alternatively, you could simply buy 1 tick above the high of this signal bar and use a wide stop, maybe a measured move down here. And if you did, you would not have been stopped out when the market went below your original signal bar. So at this point, the market goes below your signal bar. Many traders would buy more right here if they were not stopped out. If they were stopped out, they would buy anyway. So this is a fairly high probability buy signal. It's a second reversal from a new low of the day on a trading range day, and both signal bars were strong. So this is, I think, a highly probable trade. So you'd look at it and you say, okay, 60% certain that if we get above this bar, we'll go up at least equal to my risk. But what is your risk? Your initial stop was down here. It's unlikely you're going to get 1 time your initial risk, because that would be way above the high of a quiet trading range day. On the other hand, as this bar is forming, when the market's up here somewhere, you'd say, okay, this is a bull breakout, a good looking entry bar. So I'm not going to use my initial stop down here. I'm going to move my stop up to 1 tick below the low of the second signal bar. So your actual risk, had you bought above this bar and went long right here, your actual risk is from that entry price down to 1 tick below this second signal bar. 1 times that actual risk is up here. Remember, when you looked at the trade, the second entry, at this point you said, yeah, I think it's a good trade. I think it's probably going to work. even though you entered over here and not over here. At this point, there's a 60% chance that the market will go up probably 1 times the risk of an entry above this bar, maybe 1.1 times the risk of an entry above this bar. So you could take a measured move up. Let's use the original entry right here. And now you know your actual risk was right here. 1 times that level is right here. So you could place a profit-taking limit order to exit your long for a scalp at this level, and you would have been filled. So if you bought over here, you take profits over here at 1 times the risk. Most traders should not be going for 1 time the risk, but this is, I think, a high probability trade, especially when it turned up the second time. And had you decided that you were going to take the trade, given that the probability was high that you would be successful, you could get out at 1 times your risk. The actual risk, not the initial risk. The initial risk was all the way down here. Here's your entry price. So the initial risk was from your entry price all the way down there. What happens when the actual risk is actually very small? Don't adjust your target based on the actual risk, because it'll be too small for the market conditions. You have to use some other method to determine where you should begin taking partial profits. One is you could go for a partial profit based upon your initial risk. If the probability is high, maybe 1 times the initial risk and start taking profits. If the probability is high and the trade looks really strong, you'll want to exit with more than just 1 times the initial risk, maybe 2 times the initial risk, or maybe exit based upon some support or resistance. If you're shorting and it looks like a very strong setup and the support is way down here, and that's 3 or 4 times your initial risk, that's a reasonable location to take your profit. So you're basing it not on the initial risk, not on the actual risk, you're basing it upon the price action. Here's an example. A very strong bull breakout, a gap up, very strong first bar of the day, very strong second bar of the day, strong bear bar, but we couldn't even trigger a pullback. So we have a strong bull inside bar closing on its high tick. You get filled on this bar 1 tick above the high of the signal bar, and then the next bar of the market went up. Your actual risk, let's say we're at this point and you're looking at actual risk, it's only right here. So your actual risk is from your entry price to 1 tick below the entry bar. 2 times your actual risk is right here. It's not even at a new high of the day, right? When you see a huge breakout like this, you know that the odds are probably 60 or 70% that the market will go up to a measured move based on the height of the spike, from the open of this bar to the close of this bar. So somewhere up in here, probably 60, 70% chance the market will get there. And if that's the case, you certainly don't want to be exiting at 2 times your actual risk right here. So you have to use some other logic to find a place to begin to take profits. You could, here's your 2 times actual risk, do not exit there. But if you use the body, the open of the first bar of the spike to the close of the second bar of the spike, you can come up with a projection up here and take half off, for example, at 1 times that height of the spike. When the market is racing up like this, you might decide, well, it's racing, I'm going to let it run. I'll wait until I see any kind of a reversal. You could look at this and say, okay, we've had 3 pushes up here. Yes, it's not a wedge that is worth shorting. The market is almost certainly going higher, but it may pull back fairly deeply. It may pull back all the way down here, and I don't want it to come back that far. I don't want to give back that much profit. So I'll take half off either on the close of this strong bear reversal bar or right below its low. And you'll end up with a profit target that's much greater than your actual risk, and that certainly makes sense. You could say your initial risk was below the low of the bull spike, and you could have used a measured move based on your initial risk, which would be slightly more than this red line, somewhere up in here. That's okay. The key thing is don't base it on your actual risk. If your initial risk was below the signal bar, 2 times that risk is still too small, and I think that would not be a good location for an exit. That probably would have been right up here. So if you put your initial stop here, your signal's here, 2 times your initial target was right here, and you can see some profit taking took place. The market went sideways. But after this bull spike, I personally would like to go for a much bigger target. what happens when the actual risk is actually very small? Don't adjust your target based on the actual risk, because it'll be too small for the market conditions. You have to use some other method to determine where you should begin taking partial profits. One is you could go for a partial profit based upon your initial risk. If the probability is high, maybe 1 times the initial risk and start taking profits. If the probability is high and the trade looks really strong, you'll want to exit with more than just 1 times the initial risk, maybe 2 times the initial risk, or maybe exit based upon some support or resistance. If you're shorting and it looks like a very strong setup and the support is way down here, and that's 3 or 4 times your initial risk, that's a reasonable location to take your profit. So you're basing it not on the initial risk, not on the actual risk, you're basing it upon the price action. Here's another example where the actual risk is small, but instead of in a breakout, this is in a reversal. The market's trying to put in a bottom, a trending trading range day, an upper range, a lower range. You can argue final flag here, possible final flag here. In any case, you have a small bull signal bar for your setup, and if you bought 1 tick above the high of this signal bar, your initial stop might be below its low. 2 times your initial risk would have been right around here or so, and that's probably still too small a profit target given the way this market looks. The market probably will try to test one of these highs, maybe the low of the upper trading range. Your actual risk, you'd know it when the market started to go up. So maybe on this bar as it's going up, certainly by the close of this bar, you could calculate your actual risk, right? And your actual risk is from the low of your entry bar and to 1 tick above your signal bar. Had you had a stop at that price, you would not know this in advance, but had you had a stop at this price at the time you entered, the market would have missed your stop by 1 tick and then rallied. So in hindsight, you'd know that your actual risk was very small right here. And as this bar was forming, if you exited at 2 times your actual risk, you would have gotten out right here. And to me, that's unrealistic given this market, the bars to the left. The market probably is going to rally to the top of this lower range at a minimum, the bottom of the upper range. It may break into the upper range again. So you cannot use your actual risk as the basis for taking partial profits. Even your initial risk, I think, is too small because the signal bar is so tiny. So you should use some other method to determine where you should take profits. One would be to start selling at obvious resistance areas, at these swing highs. You can see some traders did that. That's what caused this tail. So they placed limit orders to sell, maybe at this high and that high. And when the market got there, those bulls took partial profits, maybe half off, and that caused this pullback. Also, they may have taken profits at the moving average or above the moving average, and that could have caused this pullback. So bottom line, when the initial risk or the actual risk are too small, you should not use them to determine where to take profits. Instead of going for 2 times your risk, actual or initial, use something else like resistance above. Sometimes you'll have very strong trends, let's say a strong bull trend, and you'll see a high 1 setup, but there'll be something that's not right about the setup. Maybe there was a 1 bar final flag before. Maybe the signal bar is a small doji bar, and you wonder if the market is starting to form a tight trading range. The same is true in a bear trend. Sometimes you'll see a low 1 in a strong bear trend, and it sometimes doesn't look quite good enough. So in a bull trend, sometimes there's a weak high 1 buy setup, and a strong bear trend, sometimes there's a weak low 1 sell setup. When that's the case, you can sometimes use your actual risk to set a profit target. If the setup is not really clear, set your target at 2 times the actual risk. You remember, you're thinking it's a weak setup and the market might be transitioning into a trading range or a tight trading range. So you're going to be quick to take profits if it does not resume another breakout. Here's an example of a strong bull trend and a strong high 1 buy setup. This is the example I showed a few minutes ago. Extremely strong bull breakout. Here's a high 1 buy. I would not be quick to take profits. I would assume that this is going to run, so I would swing most of that. The market is still breaking out and still very strong, and II, 2 bear bars. But to me, I would not be scalping for 1 point. I would let this go and see where it goes. And even if it pulled back, I would let it pull back and rely on a stop, maybe below this bull bar, the most recent big bull bar, or the most recent higher low, which probably would be that. And I would let that go. Here, it's not nearly as strong. We have a very strong bull spike, but it's the third push up, and we have bars that are getting bigger and suddenly a very big bar. This could be a buy climax and the start of a trading range or a pullback. So this is a weaker high one buy setup. I think you can still buy it, but management is tricky, and I probably would try to go for 2 times actual risk. So actual risk might be 1 tick below the signal bar, 1 tick above, and then 2 times that would be right around here. And it looks like a lot of traders did exactly that. When you have a strong bull trend but a weak high one buy setup, life becomes much more difficult. You have to decide what to do. Here we have a bottom and an extremely strong bull breakout, and now the bars are even getting bigger. These last 2 bars are extremely big, but look where they're going. They're going right up to a prior high, earlier, a high from the day before. So it might simply be a buy vacuum testing yesterday's high, and therefore a buy climax, and there might not be more follow through. If this bar closed way up here, then I would say, yeah, we broke way above these bars, and I'd be much more inclined to buy a high one up here. But when the market just races up here and goes a tick or 2 above a resistance level, and then has a tail, and then the next bar is a doji bar, a small doji bar, to me, yes, it's a high one, but it could be simply a buy climax that's testing resistance. This could simply be a buy vacuum getting sucked up to resistance, and then profit takers will come in. So to me, this is a weak high one buy, and it's tricky to manage it. Can you buy it? Absolutely, you can buy it. But if you buy that, you initially have to rely on a swing stop, maybe below the low of the 2 bar spike. And if I were you, I would trade small and look to add on at a location where traders might have protective stops. Traders might have stops below the low of the bar. So that would be a good place to add on and maybe risk 2 or 3 times that, or keep your initial stop down here. But then I would also be thinking about, if the market does not go my way quickly, getting out at break even. All right, so here the market went up again, but quickly turned down in a 2 bar reversal. It went 1 tick below. Okay, so at this point, I would be hoping that the market comes back up high enough so that I can get out break even. At this point, after this strong bear bar, I probably would not be trying to get out around my original entry price, 1 tick above the high of that bar. I probably would look at my entry price, look at my add-on, and try to look to get out around the midpoint, and I probably would have gotten out around here at break even. So even though there's a very strong bull move, there's a weak high one buy signal bar, and it's at resistance. In general, I don't want to buy high ones after buy climaxes, and I certainly don't want to buy high ones right below resistance after a buy climax. But had I bought that, I would have managed it similar to what I just said. So just seeing a high one after an extremely strong bull move is not reason enough to buy. Here's a high one in a bull trend, and the probability is good. And when the probability is good, you can exit at 1 times your actual risk. You might call it, if let's say you bought above this bar, right? It's a high one, a bull trend, no obvious resistance to the left. There might be some measured move targets up there, but I don't see any really strong obvious resistance like a trend line or a trend channel line. So to me, that's a reasonable high one buy. The market triggered, but immediately reversed down. And if you bought it, you could manage it like the prior trade. Keep an initial stop below the big 2 bar bull spike, and then see what happens. Okay, at this point, the market probably didn't fall low enough for you to buy more. This is a 15-minute spider chart, by the way. Just to mention that you can use price action on any kind of a chart, any time frame. All right, so once the market started to turn up a second time, then we have a high 2 buy, right? You bought the high 1, but now it's triggering a high 2, and that in a bull trend, that's a higher probability bet. There's a double bottom. This doji bottom, it went up and then down again. So at this point, as the market goes above this buy, you realize that the probability is high that the trade will be successful. At that point, you can say, okay, high probability, I can exit 1 times risk. We're getting dojis here. We might be entering a tight trading range. So I don't need to hold for 2 times risk since the probability is high. So at that point, you could try to scalp out for 1 times the risk and take profits right here. A lot of traders, if they did not buy the first time, they would have bought the second time because it's a high 2. Many traders who bought the high 1, if they see a second signal, they'll buy more. And since the second signal is higher probability, they could exit for a scalp at 1 point. Here's a bear trend, a strong bear trend. You can argue, well, Al, it's really a channel, and therefore it's not a strong bear. At this point, it is a strong bear. We have a breakout, and here's a low 1 short. And it's a pretty good low 1. This is a strong low 1 short. I think that's a very good one to take. However, look at this one right here. Okay? This could be a 1-bar final flag. We have a possible reversal here. And then we have this signal bar here. This very small bar is a signal bar, and it's a doji. So we have a doji here, and small bars here. The market might be evolving into a tight trading range. So to me, that's a weak sell setup. If you took it and you were thinking, okay, it's a bear trend, I'm going to short anything for any reason, you probably would be using a swing stop, which would be maybe up here or maybe even up here. And at the moment you took the trade, your stop is somewhere here or here. And then you have to decide what to do. At some point, you decide in here that, yeah, the trend is resuming. So maybe with 4 consecutive bear bars, even though they're small, you might decide, okay, I think the trend is going down. And at that point, you know that your stop is going to be above this high, your new stop, and your actual risk was from the entry price, 1 tick below the low of that bar, to 1 tick above the high of this bar. And the probability is good at this point. Here's another weak low one, but let me deal with this one right now. Okay, so as the market is going down 3, 4, 5 bars, you believe the trend is resuming, so you know your actual risk is right here. And you could either take part off at 1 times actual risk, or you could go 2 times actual risk. If you think, well, maybe the probability is 50-50, then go for 2 times actual risk. Here's a similar situation. If you shorted this low 1 below 2 bull bars after consecutive sell climaxes, sell climax here, sell climax here, sell climax here, and the market might be starting to correct. Initial stop above the spike. Okay. Once the market started to turn down, here all you need is 1 or 2 big bear bars to believe the market is resuming. You'd move the stop from above the most recent higher high, or the top of this new bear spike, to above this lower high. I said higher high, I meant lower high. Anyway, as the market's resuming down here, you tighten your stop over to here, and you could calculate your actual risk. And your actual risk was from your entry price, 1 tick below this bull bar, to 1 tick above this lower high. And you could say, okay, when I took the trade, I'm not all that certain. When I'm shorting here, I'm not all that certain. I could go for 1 times risk and be happy to get out. Or I could say mathematically, I took a lower probability trade. I should go for 2 times risk. It's a strong bear trend day. I don't want to take profits too soon. Maybe I'll take profits at 2 times risk. And you can see what happened when it reached the 2 times risk area. There was a pullback. So you were not alone in taking profits in that area. That is the end of my module on actual risk.